Okay, so chapter 13 is the last chapter we're doing this semester. And basically, to close out the semester, we're, we're typically just having you focus on all the basic financial statements, and they're going to review the closing procedures one more time. So just remember that we still have your basic income statement, which will be the first financial statement, except in chapter 13, they're going to call it a classified type of income statement where they have certain types of headings and line items they want you to focus on when you put it together. The second one is going to be your statement of equity. That one is essentially the same as what you've already prepared. And then the third one, again, is going to be the balance sheet. And the thing that's going to be changing in this chapter about the balance sheet is that, again, it's going to be what's called a classified balance sheet, where you have certain headings they want you to categorize your accounts under. But the basic idea is still the same. It's still going to be income statement, flows to equity, flows to balance sheet, except the focus in this particular chapter is more on the presentation and how investors and creditors actually want these financial statements to look like. Okay, so again, in this chapter, we're going to be doing a classified income statement. And basically, sometimes this is called a multi-step income statement. And you'll see once we look at some examples in your textbook, does give you multiple illustrations on what it looks like. It looks like a lot, but basically it just has different categories and account headings that they want you to group all your accounts under. You still are calculating net income. It's just basically how you arrange the accounts and categories. Now, up to this point, what you basically have been doing is what they call a single step income statement. And that's where all you do is you take all your revenues, you put them in, you just basically add them up. You take all of your expenses and you just group them up, and you simply subtract to get net income, of course, or net loss. So single step meaning you just group them all together. You don't have any distinguishing features about any types of revenues or expenses. You just basically say if it's revenue, it's revenue. If it's an expense, then it's an expense. And that's the single step income statement. So we're going to be a little bit more cautious in terms of detail in this chapter when we look at the multiple step income statement. Now, one of the categories obviously is revenue. That's usually your first thing you want to put up in any income statement. And you'll notice in this particular example, in terms of what we've been looking at in the past few chapters, we have a sales account, which is our revenue account. We could have sales returns and allowances. Remember, you have to subtract those because those reduce revenue. And it's not listed on this slide, but you could also have sales discounts added into the mix. That could also be into this category as well. You'd have to subtract that as well. And then notice you have a category which is called net sales. So like I said before, this category, that's basically indicative of what's under a multiple step income statement. That's in a heading. It's called net sales. And that's typically how investors and creditors want to see this type of income statement listed. So you could really look at this as one of the headings called net sales. That's going to be a little bit different than the single step income statement. Now, the concept of cost of goods sold is also going to be a main heading in this classified income statement. Cost of goods sold is simply, basically, you're going to be expensing your merchandise inventory. So this category right here, COGS, cost of goods sold, is going to be a calculation. And the basic idea is what you do is you take the beginning inventory, you're going to add all of your net cost of purchases. Okay, so you're going to add that. And then, of course, you will subtract out the ending inventory, and that's going to give you your cost of goods sold. So think of this as kind of like a formula. It's actually presented on the income statement, and you might be thinking, oh, wait a minute, inventory is an asset. It should be on the balance sheet, and that's true. But under this type of income statement, they do like to see the actual calculation of how you calculate the cost of goods sold. And so this is going to be the formula that we're going to follow. And so you might be asking, what is the net delivered cost of purchases? So basically, it's all your purchases plus your freight cost. Remember, you do have to subtract out any sort of returns and discounts. And guys, that's going to give you your net cost of inventory. So the basic idea is you'll take any beginning inventory at the beginning of the period. You're going to add this net delivered cost. That's going to equal your total cost available for sale. And then, of course, the next step would be to subtract out your ending inventory. I'm going to write this one in here. Your ending inventory, you subtract that out. And then the final step is that's going to give you the cost of goods sold. And again, just to kind of repeat it again, here it is, same formula, beginning inventory plus your net cost of purchases equals cost available for sale minus ending inventory equals your cost of goods sold. This is basically, I'll kind of give you another hint, this is basically your inventory expense account that we use on the income statement. So you can see this is again a partial look of how this would show up on this classified income statement. So you better believe it, this whole section right here, that's going to be one section on this income statement. Notice it has all the calculations on how to come up with that cost of goods sold. So notice you've got your beginning inventory. These are all your costs and any returns and allowances. And notice this number right here, the 325, that's your total delivered cost. You add that, you add all that to this beginning inventory. You then get your available for sale. You're going to subtract out that ending inventory. And guys, there it is. That's your cost of goods sold. All this is actually shown on the income statement. So then the next category on this classified income statement is something called gross profit or gross margin. And that's basically just when you take, I'm going to pencil this in over here. That's when you take your net sales and you're going to subtract out your cost of goods sold, and that's going to be the calculation on how to get gross profit. So on this classified income statement, you're going to look at these as three major headings. You'll have net sales as a heading, cost of goods sold is another major category, and gross profit is another major category. This is basically just what you're making on inventory. It's not paying anything else. Gross profit just means what have you made. Your revenue covers your cost of inventory. It's called gross profit. It's not net profit, but it basically tells you what you're making on inventory. So then that tells you what you have left to pay your other costs, your other admin and other operating costs. And of course, down here, it kind of summarizes it again. Gross profit, again, is the difference between your net sales and the cost of goods sold. So notice this is how it's going to look on your income statement. And I'm just going to kind of highlight the main area, the main heading. So I'm going to circle number one, guys. This is your net sales. Everything over here goes into calculating your cost of goods sold. This is your inventory formula. So this number right down here is your cost of goods sold. And if you take your net sales minus your cost of goods sold, that's going to give you your gross profit, which in this case was $219,030. Now, once you've gotten gross profit, and again, I'm going to make sure you see this number right up here. Once you get this gross profit, everything below gross profit is all of your other expenses, selling, admin, whatever it takes to run the company, but it's basically all your non-inventory types of period costs. And notice you have all these categories. You have operating expenses, general, admin, and they list them all out here. And then basically you have a category here that just at the final stop says total operating expenses, which in this case would be the 167,836. But just remember that once you get to gross profit, that's basically what you made on your inventory. Everything below gross profit is all your operating expenses. And you'll find out another term they like to call these are period types of expenses. You know, sales salaries, advertising, supplies expense, rent, insurance, and so forth. All right. And that would then at that point you have a couple more categories to look at, but that's covering just about all of your multiple step income statement. So then you notice finally, this is a nice little picture of again your partial income statement. Notice again, you got here at the top, I'll just kind of emphasize this. Here's your net sales. There's your cost of goods sold. Notice they don't show you the whole calculation on this particular slide just to kind of so they could put it into one slide because it gets really, really long. But your basic idea is you subtract out your cost of goods sold. So there would be your gross profit. Everything below gross profit is all of your operating expenses. And at that point, once you subtract out all those, there's your net income. In this case, it's from operations. Now, the final step, the final things are all the kind of weird items. Sometimes on an income statement, a company will have what they call other income or other expenses. Typically, the other category basically are activities that I'm going to call these are non-normal operating activities, okay? And what I mean by that is, you know, from time to time, a company might do some investing in other companies, which is not part of their normal operations. Like you could have a McDonald's corporation might be investing in stocks and bonds and so forth. and have other miscellaneous income from extra cash reserves. And that's fine and great, but because McDonald's is not in the business of buying and selling stock, that's not what they do. They have to put this into another category, and they call this a other category. Just like you can have other income, you could also have other types of expenses that are non-operating related. And the investors and the creditors like to see these other categories, these other income, other expense items, or basically categories, so that they can see exactly what's going on with all of their profit activities. And you can see then once you kind of take care of all that, notice there's a category here called your income from operations, and then everything down here is all of your non-operating type of activities. You have to take care of those. And then of course, once you've netted all those, you get basically your net operating or non-operating types of expense. And then at that point, you can then finally get to your final net income number. Now, on this one, this is no different from what you've already done. Actually, this is, I'm just going to write this in here. This is basically review. This is not changed from any of the chapters. This is your equity statement, which again is your financial statement number 2. And so it's the same idea. You have a beginning capital, you add net income, you subtract any withdrawals to get that updated ending capital balance, which goes on your balance sheet. Okay, so next up, we're going to talk about what's called your classified balance sheet. And again, remember, your balance sheet is still your assets equals your liabilities plus equity. That's not changing. But what is going to change is starting with the asset section, they want you to group your assets between what they call a current asset, and I'm going to write this here, and a non-current asset. And the simple way you remember these is a current asset is any asset that's either going to be used or converted to cash. We're going to use 1 year, within 1 year period. So, and again, they try to emphasize down here 1 year. So think of the different types of assets, and your book gives you numerous illustrations in this chapter, and so study these in terms of what is a current asset. Investors and creditors like to see the current assets listed by themselves. So I like to tell my students in my face-to-face classes, you got 2 types of assets. It's either going to be a current asset or a non-current asset. And so if the current asset, if we use the 1 year criteria to define those, the non-current asset is any asset that's basically either going to be used or converted to cash, but it takes more than 1 year. That's essentially going to be kind of like your property, plant, and equipment types of assets. And if you look at this particular example, you can see all the different types of examples of current assets they give you here. So I would just suggest you study these, get used to the idea. Remember the one on notes, anytime you see a note receivable, that could go either way. So any problem would have to kind of specify, what's the dates on the receivables. But typically all your prepaids, your inventory, interest, and so forth, all that's going to be in what they call the current asset section. Now, like I said before, your plant and equipment, these are your type of assets that basically are used for more than 1 year. So they're basically long-term in nature. So you're going to have a different category. You're going to call it plant and equipment. And notice you have all your equipments. And remember that you still have the accumulated depreciation account. You can't forget about that. But that's also going to be included in this section of your balance sheet. And so we'll call those the plant and equipment types of assets. And just like your total current assets, you also have a category for your what they call the current liabilities. Think of this as current liabilities. This is your debt that's due literally within 1 year. So it's your short-term debt. So if you look at the examples, you got some notes payable, accounts payable, interest. So you list them all. These are all due within a year. You have to categorize these and group these in the section, and you're going to call it your total current liabilities. So just like the total current assets, which we said with 1 year, and then you had the non-current assets which were more than a year, it's the same thing with the liabilities. We have current liabilities, and we're also going to have long-term liabilities. And if you think about it, all this is this is your debt that's due for more than 1 year. So it's not due this year, it's going to be due in future years. And so again, like I just said, your long-term liabilities are debt that's due for more than 1 year. And some typical examples could be like mortgages. You could have long-term notes payable or other types of loan payables that's not due immediately, but the investors and creditors want to see that in the category called the long-term liabilities. And so just remember, once you do that equity statement, remember the equity statement is your second financial statement. That equity balance does then go to your equity part on the balance sheet. You just call it your capital. And then once you get that, you add that to all of your liabilities, and hopefully your assets still equal your liabilities plus owner's equity. Okay, the final thing we'll talk about, again, this is going to be a review. Again, nothing's really changing. It's just the closing process of resetting your books, and so you're getting ready for the next accounting period. So one thing you got to remember that is that when you are doing closing entries, you're basically closing out what's called the temporary accounts. The temporary accounts can easily be remembered because these are the accounts that are either on the income statement. And remember what's on the income statement? Revenues and expenses. That's these first two. And then remember the oddball one is your drawing. So if you can remember, it's income statement accounts, which are these right here, plus your drawing. Those are the accounts you're going to close out. And essentially you're going to transfer, okay, you're going to transfer those balances into the capital account, okay? Because that's basically what we're doing is we're updating the capital account. So going with the four-step process, the first step would be to, number one, we're going to close out the revenues. And basically what's going to happen is we're going to close that out to income summary. Then we'll close out the costs or the expense accounts to income summary. And then we're going to close out the income summary. That's where you transfer all your revenues and your expenses into capital. And then the final step is simply just to close out the drawing to capital. Once you've done that, the closing process is complete. And here's your first entry in terms of just closing out revenues. Notice here's your sales, you got interest income, miscellaneous, your purchases, returns, and allowances and discounts. You close all those out. Close the income summary. Notice that's a credit to income summary. And then you've closed out all of your revenues and, of course, the cost of goods sold, the inventory aspect, to income summary. Second step is to close out all of your expenses, and that's a lot of them. So there's this kind of listing all these expenses right here. You're going to credit those balances. One debit is going to go to income summary. So this being your second step, you've just closed out your expenses. And then, of course, the third step is you have to figure out what's the balance in the income summary account. Is it going to be a debit or a credit balance? In this case, it turned out to be a credit balance. And because it's a credit balance, to close out income summary at that point, you would be debiting income summary and crediting capital. So this will be your third step. That's to get rid of the income summary balances and transfer those balances into the capital account. And then the final step is simply to take, if you have a drawing account, take that drawing account, close it out. So you're going to be debiting capital, crediting the drawing account. And again, this will be the fourth step, and then you're done with your closing process. And then once you have closed out all of your temporary accounts, you would then do what's called a post-closing trial balance. And then what's going to happen then is you'll have your debits and your credits. Make sure you're still in balance. The only thing that should be left essentially is your permanent account. And just to kind of remember, in your post-closing trial balance, remember, just because your debits do equal your credits, remember, this is not a financial statement, but there could still be some mistakes and errors. I'm not going to get into that right now. But yeah, you could still have issues, but the focus is your debits equal your credits. The only accounts that should be appearing on this is basically your balance sheet accounts. So read through that. Assets, liabilities, and equity should be the only accounts left that have any sort of balance in your post-closing trial balance. And then notice here's a listing of a post-closing trial balance. Notice the debits do equal the credits. And notice if you look at all of these accounts listed, these are all balance sheet accounts. There's no revenue, no expense, no drawing, no anything. This is all basically assets, liabilities, and equity. So that's called your post-closing trial balance.